Welcome, Marci, and thank you for joining me today. There are many factors impacting the global economy right now. The war in Ukraine, the supply chain, climbing inflation. What do you think is mostly driving the market right now?
Well, I think the biggest thing that's happening right now overall is that central banks around the world are raising interest rates. The era of free money is pretty much over with, and I don't see that necessarily as a bad thing. We're transitioning right now from the post-pandemic environment into something that I see as a return to normal. Now, that return to normal is not the normal that existed prior to 2020. We don't ever go back there. This is I hate the cliche, it is a new normal. It's a normal where you're going to have more flexible workplaces. It's a normal where monetary policy will move to a situation where interest rates are no longer going to be rock bottom. It is an economy that grows, in the US at least, more like 2%. Instead of these wacky numbers that we've seen as activity collapses because of the pandemic and then bounces back much more strongly than anyone expected, giving you supply chain issues, giving you inflation rates that are really a reflection of this pandemic bounce back rather than some sort of underlying long-term trend in the overall economy. This is going back to normal, and this is what it was going to look like.
Well, I like that. I'm with you on the new normal. Marci, let's talk about the R word, recession. You know, we've all been anticipating this downturn for a while now. When is it going to happen?
Well, I actually am in the camp that a recession is most likely to be avoided. Because remember that a recession is defined as a period of economic contraction. It isn't that activity slows down. It isn't that you transition. In order to have a recession, you actually have to have activity actually fall. You have to have consumer spending decline. You have to have business investment shrink. You have to have unemployment increase. I can find it on television. I can find it on the internet. I can find it with my friends and neighbors. But I can't actually. The recession is all over the place, everywhere, except in the actual data. And you can talk to people and say, hey, I know you think there's a recession, but how's your business doing? And they go, gangbusters, never been stronger. Well, both things can't exist at the same time. We are now in an era where the cost of capital is increasing, which means the bar for projects is higher than it used to be. So sure, you're gonna get fewer deals done, you're gonna have fewer projects, you're gonna have fewer transactions. But the truth is, nothing about the last 2 years was sustainable. So we're moving to something that's sustainable.
I've been hearing the same thing from most of the industry folks in commercial real estate, that things are still pretty much going pretty well. So we'll see what happens. Let's talk about another R word, retirement. In terms of retirement savings and 401k, is the worst of it yet to come, or have we already seen it?
Well, there's actually no way to know, no way to answer that question.
Wait, you're not looking at your crystal ball?
I know, right? If I could predict the future path of stock prices, I wouldn't be working. No, you wouldn't be seeing me here. In truth, one of the things that people have to remember is that when it comes to the stock market, it doesn't just go up. In fact, it can contract dramatically. A 20% decline in stock prices, a bear market, those things happen. They absolutely do. Part of the transition that we're experiencing right now, what drove stock prices up were primarily the top 5 technology stocks. And technology stocks are most sensitive to interest rate increases, right? So we're living through a period where they're driving down, particularly technology stocks are driving the market down, and you can see this in the difference between the S&P 500 and the NASDAQ. So stocks go up, stocks go down. This is just one of those times when it's happening. But I want to remind everyone out there, when it comes to your investments and your retirement, and I will say this until the day I personally leave this earth, any money you need in the next 5 years should never be invested in stocks, because it can take 5 years for stock prices to recover.
How can commercial real estate professionals prepare their clients and businesses for what's to come?
Well, I do think that it helps to take this perspective of we are going back to normal. And in a normal environment, making money is actually not easy. It's hard. Doing deals are not always easy. It's going to be a little bit harder. Cost of capital is going up, and everybody can't be a real estate professional the way that they could 2 years ago, right? So you're going back to more normal markets. And I think, though, that we have to remember that it isn't just the economy that commercial real estate is sensitive to. It's also the health of the banking sector. Banks are super healthy. Their balance sheets look good. Credit conditions have never sort of swung from super loose to super tight. And I think that's something that we need to keep in mind as well in looking at sort of what the year looks like in the next 18 months. And keep in mind, too, that what's going on right now in this like month or two, I don't think that that's the environment that we're going to see 6 months out. This is the adjustment period.
Well, that's a great note to end on. Thank you, Marci. Thanks for being with us and sharing your expertise and knowledge.
Thank you, Wendy.